Hey everyone, welcome back to the deep dive. You're here because you want to get right to the heart of things. You want to understand what really matters. And today we're diving into the world of a financial legend, Warren Buffett.
Yeah, that's right. We've got a mountain of research here. Articles, books, interviews, all about how Buffett turned $100 into, well, 100 billion.
It's a pretty incredible journey, and our goal today is to really break down the core strategies that made that kind of growth possible. We want to see what lessons, what insights we can pull out that you can actually use wherever you are on your own financial journey.
Absolutely. And I think when you look at Buffett's trajectory, it becomes clear it wasn't just luck or being in the right place at the right time. There was a very deliberate, consistent application of some key principles at play here. So let's unpack those.
Let's go all the way back to the beginning. 11-year-old Warren Buffett in 1941, our sources talk about how he buys his very first stock for $114.
Imagine that. 11 years old, already getting into the stock market.
Right. And then just 5 years later, by the time he's 16, he's already built up a portfolio worth, get this, the equivalent of $53,000 in today's money.
That kind of early success is, well, it's pretty remarkable. It really shows you the power of starting early and putting these basic strategies into action. One of the approaches they highlight from his early days is something called the cigar butt strategy.
Cigar butt? What's that about?
Yeah, it sounds a little strange, right? So the cigar butt strategy wasn't about investing in those hot up-and-coming companies that everyone's talking about. Instead, it was about finding those struggling businesses, the ones that are maybe on their last legs, like a discarded cigar butt with just one or two puffs left.
Okay, I get the analogy.
The goal was to buy these businesses for dirt cheap, basically, extract whatever value was left in their assets, and turn a small profit. Not exactly glamorous, but it was a practical way for a young Buffett to start making returns with, limited capital.
So it was about squeezing every last bit of value out of these undervalued situations. And this early approach was combined with a real emphasis on something we talk about a lot on this show: compound interest. The sources really emphasize how Buffett would reinvest every single dividend he earned, like that classic snowball effect, right? Starts small, but it grows exponentially over time as the earnings themselves start generating more and more returns.
Exactly. Compound interest is incredibly powerful, especially over the long term. By consistently reinvesting those earnings, you create this cycle, where the earnings then contribute to even more growth.
Mm.
It does take patience, but that cumulative effect can be, well, it can be huge.
And underlying all of this, those early moves was this strong focus on avoiding losses. The sources call it the no loss rule. The core idea is to protect your capital above all else.
It sounds so simple, but it speaks to this really deliberate mindset of careful risk assessment, especially in those early years.
And there's that classic quote, right? Rule number one, never lose money.
Exactly. I mean, it's not just about picking the big winners, but it's fundamentally about protecting your downside. By avoiding big losses, you safeguard your capital, and you allow that compounding effect to really work its magic over the long run.
Makes sense.
Even at a young age, Buffett seemed to grasp this intuitively. I mean, there's this anecdote where he says, and I'm quoting here, "I always knew I'd be rich." It suggests this remarkable early confidence, probably stemming from that disciplined, risk-aware approach. Although, the no-loss rule, while it sounds great in theory, I wonder how realistic it is for the average investor, especially when they're starting out with limited capital. I mean, are there times when taking calculated risks might be necessary for more significant growth?
That's a good point. I guess maybe it's more about minimizing unnecessary risks, really understanding the potential downsides of any investment before you jump in. So this brings us to a kind of interesting turn in the story: the acquisition of Berkshire Hathaway.
Oh, yeah, Berkshire Hathaway.
Now, the sources make it pretty clear that it was a struggling textile mill when he bought it. So how did this struggling business become the foundation for this massive empire that Buffett built? It seems a little counterintuitive, doesn't it?
It does at first glance. The textile business itself was, yeah, it was definitely facing some headwinds. But the real value wasn't in the textiles. It was in the insurance companies that Buffett later acquired and strategically placed under the Berkshire Hathaway umbrella.
So he was playing a different game.
Exactly. And this is where the concept of float becomes really important. Think of it like this. When you pay your car insurance premium, the company has your money for a while, right? Before they might have to pay out a claim. That collected money the money they haven't paid out yet. That's what's called float.
Float, okay.
Buffett recognized that this float was essentially a big pool of capital that he could invest, and often at no direct cost.
Ah, I see. So it's like having access to this huge interest-free loan that you can use to generate returns.
Precisely. This access to a large and consistent source of capital allowed Buffett to implement his famous buy and hold forever philosophy on a much grander scale.
Buy and hold forever.
Yep. And we see this with classic examples like Coca-Cola, which Berkshire Hathaway has held for like over 30 years.
Yeah, that's a long time.
It is. And now it generates something like $700 million a year in dividends for them. Then there are those other long-term holdings like Apple and See's Candies. The basic idea is to identify those high-quality companies, those companies with strong, lasting competitive advantages, and then hold on to them, even through the ups and downs of the market. You let the underlying businesses grow and let those dividends compound over time.
It's all about patience and that long-term outlook. You're resisting that urge to constantly buy and sell based on those short-term market fluctuations. And it seems like this long-term perspective also ties into this idea of being a contrarian investor, the idea of being greedy when others are fearful, right?
Yeah, right. That's a great point. And a prime example is the 2008 financial crisis. While everyone else was panicking, Buffett made significant investments in Goldman Sachs, when the entire financial world seemed like it was on the verge of collapse.
Pretty gutsy move.
It was. And it illustrates his ability to think differently than the crowd. When markets are in turmoil, when prices are down, that's often when you can find those most attractive long-term investment opportunities if you believe in the fundamental value of the business.
So when everyone else is running for the exits, that's when Buffett sees opportunity.
Exactly. And it's around this time that we see this shift in his thinking. He famously said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price."
Interesting.
It signaled a shift away from that deep value focus of the cigar butt strategy towards prioritizing quality and long-term sustainability.
So what makes a company wonderful in Buffett's terms?
Wonderful companies. They often have these strong, they call them moats, durable competitive advantages that make it hard for competitors to take away their market share or erode their profits.
Moats, like the moats around a castle.
Yeah, exactly. It's like a defensive barrier. For companies, these moats could be things like a strong brand, patents, or a unique distribution network, anything that makes it tough for rivals to compete.
Okay, I'm getting a clearer picture of this.
Good. Now, our sources bring up this really interesting concept. They call it the untold compounding advantage. Tax efficiency.
Tax efficiency. That's not usually the first thing that comes to mind when you're talking about, investment strategies.
It's not, but it played a crucial role in Buffett's wealth building. And it comes down to something called the never sell loophole. The idea is pretty straightforward. By holding on to those stocks for really long periods, Buffett mostly avoided those capital gains taxes.
Remind me, how do capital gains taxes work again?
Sure. So you only pay capital gains tax when you sell an asset, like a stock, and you make a profit.
Yeah.
So by holding those high-quality companies for decades, the gains just kept compounding year after year, and it was all tax-deferred.
Ah, so he's letting that money grow and grow without having to give a chunk of it to the tax man every time he makes a trade.
Exactly. Compare that to someone who's constantly buying and selling. They're triggering taxable events all the time, which reduces that overall compounding effect.
And this tax efficiency works hand in hand with that dividend reinvestment strategy, right?
Absolutely. The sources talk about how when those dividends from a company like Apple are automatically reinvested, they buy more Apple stock, and it's all happening without immediately triggering those tax liabilities. They even show a chart with this potential growth from $1 million to $100 million through this kind of consistent reinvestment. It's a powerful visual.
100 million, wow.
Right. It really shows you the synergy of these strategies, investing in those quality assets, reinvesting the dividends to buy more shares, and then deferring those capital gains taxes by holding for the long term. It's a remarkably efficient way to build wealth over time.
It sounds almost too good to be true.
I know, right? And then there's this interesting detail that came out in Buffett's will, what they call the 90-10 rule. Basically, he recommends putting 90% of his wife's money into a low-cost S&P 500 index fund, and then the remaining 10% in short-term government bonds. It's fascinating because even Buffett, the ultimate stock picker, recognizes the value of simple, diversified index investing for most people.
That is surprising. And it
Yeah.
kind of makes this whole approach feel more accessible, doesn't it?
For sure. It shows that you don't have to be a financial genius to benefit from these principles. And just to drive home the power of this, the material points out that a $10,000 investment made with Buffett back in 1960 is. But that's the result of decades of patient, disciplined investing, sticking to those core strategies.
Okay, so for everyone listening, how do we translate all of this, these high-level principles, into something we can actually use? I mean, we might not all have billions of dollars to invest.
Right. So one of the key takeaways is this idea of what they call buying boring monopolies.
Boring monopolies.
Yeah. They're those stable, profitable companies with dominant positions in their markets, the ones that just keep chugging along. Companies like Coca-Cola, Moody's, Kraft Heinz, those businesses that just consistently generate cash and have those strong, recognizable brands.
So not necessarily the flashy, exciting startups, but those steady earners.
Exactly. We're talking about those companies with those enduring competitive advantages, those moats that protect their profitability over the long haul. They might not be the most talked about stocks, but they're often the solid, reliable performers that you can build a portfolio around.
And something everyone can do, no matter how much money they have, is reinvest those dividends.
Absolutely. And the sources actually explain how you can set up something called a dividend reinvestment plan, or DRIP, right through your brokerage app.
I've heard of DRPs. It basically takes those dividends and automatically uses them to buy more of the same stock, right?
Yep. It's like putting those earnings immediately back to work, buying those fractional shares, and accelerating those returns without you having to lift a finger. It's a simple but incredibly powerful tool for long-term wealth building.
Okay, so we've got boring monopolies, we've got dividend reinvestment. Anything else people should keep in mind?
Well, the thing that really underpins all of this is time and patience. The material draws this contrast between the results of short-term trading and Buffett's long-term approach. They even have this visual comparing how time in the market tends to outperform timing the market.
Time in the market, not timing the market.
That's the key. Short-term market movements are notoriously unpredictable, and trying to time those ups and downs, well, it's really difficult, and frankly, most people lose money doing it. Buffett's success is a testament to holding on to those quality investments through those inevitable market cycles and letting those underlying businesses generate that wealth over the long haul.
And it all comes down to patience, like you said. There's that great quote from Buffett, right? The stock market is a device for transferring money from the impatient to the patient.
Exactly. So while Buffett's strategy might not be the most glamorous, buy quality, hold patiently, reinvest consistently, its effectiveness is undeniable. He's built an incredible fortune using these principles.
And that leads us to you, the listener. What resonates with you from all of this? Are these principles you could see yourself incorporating, even in a small way, into your own financial planning?
At the end of the day, it's about consistency and having that long-term mindset. As you think about your own investment approach, consider the current market. What boring monopolies might be out there right now? Those companies that could offer those consistent returns over the long haul. It's a question worth exploring as you think about the power of patient investing and the wisdom behind Warren Buffett's approach.
Thanks for joining us for this deep dive, everyone. We'll see you next time.
See you then.